You often use the analogy of, if you have a boat that has a leak in it, you've got a real problem. And if you know that inflation at some level exists, you've already got a problem. So when did you begin to think, okay, I've got this? In fact, what I'm really, the part that I find so intriguing about your story is when you turned to Wall Street and were like, I have a profitable company. It is wildly profitable. And yet Wall Street does not like it. Dear Wall Street, why do you not like my company? And the answer to this is so revealing.
Yeah, the company was valued at like 1 times revenue plus cash. And I said, well, I have 500 million in cash. Why don't we get more credit? And the answer is cash is trash. Like it's Ray Dalio's quote, cash is trash. Well, why is cash trash? Well, if the money supply is expanding at 7% a year, then the risk-free hurdle rate is 7%. If you don't generate more than 7% yield on your cash, then it's devaluing. So from 2010 to 2020, the money supply expanded at 7%. So all the cash you're holding is losing 7% of its value, assuming you have a 0% interest rate or zero yield on the cash. So you can imagine the traditional world, you invest your cash at 3% treasury yields and you get a -7 and it's like a -4% and divide 4 into 72. And somewhere 15, 20 years out, you're going to lose half of the shareholder value in the treasury if you do that. People might hold their nose. But after March of 2000, the money supply is expanding at 24%. The interest rate's 0. So now you have to put a forecast in place. At what rate will the money supply expand? If it expands at 20% a year and you're going to generate 0 in treasury yield, then you're looking at cutting your treasury purchasing power in half in 3.5 years.
Whoa.
Okay, now that's not trivial. So you have to find a way if you're gonna have assets to get over the hurdle rate. Another way to say it is, I have to invest it in a strategy which is going to appreciate faster than the money is devalued. If the money is devalued at 7% a year, then the S&P 500 index better yield 9 or 10%. If it yields 10% and the money devalues at 7%, you're +3. You can save money in an S&P 500 index fund. You can't save money with bonds unless you're buying bonds and the interest rates keep getting reduced. If you bought a bond at 4% yield and the interest rate got taken down to 3.5, the bond trades up. And when the interest rate goes down to 3, it trades up again. And when it goes down to 2.5, it trades up again. When the bond rates or the LIBOR, the short-term bond rate and interest rate goes to 0, you can't take it down anymore. So bonds won't hold value either. So now you're in a conundrum. I have a lot of assets, but I'm not beating the hurdle rate, and the hurdle just tripled. This is the problem that a company that's cash rich has, and it's a problem that anybody that works for a salary has, which is I generate a cash and the currency is being devalued every year. The real question is, what's the rate at which it's devalued? And let's do the thought experiment. What if we didn't print any more money? What if the inflation rate, the monetary inflation rate, not the CPI, but what if the money expansion rate was 0? In that case, the currency is also an asset and it's a store of value and a medium of exchange at the same time. That's a complete Austrian economics, like deflationary economy where we call it hard money or sound money. The closest thing to that would be the gold standard. If the government said you can exchange your money for gold at any time and we'll keep gold equal to the amount of money and we won't print any more money, well, that puts you on a hard money standard. In that case, you could just store your money in a bank and it would be more valuable in the future, not less valuable. When the government goes off the gold standard, and we went off the gold standard explicitly in 1971, now the currency is losing some percent of its purchasing power every year because it's being inflated away. And what's the number? Well, it was about 7% a year, and now it's like 20% a year, and 15 to 20% a year, and you got to figure out, is it 15, 20, or 25? But if it's 15 to 20, the currency is weakening 1 to 2% a month. When it gets to be 40 to 50, it's collapsing. That's Argentina or worse. So you've either got a country where the currency is weakening or a country where the currency is collapsing. When that happens, now you have a decomposition. The money is broken into two components. You have a currency component, which you use as a legal medium of exchange, like the dollar or the euro or the yen or the renminbi. And then you have an asset component, which you use as a store of value over the long term. Money or U.S. dollars have ceased to be a store of value for at least the past decade, since the great financial crisis. So what people did was they stampeded into ETFs and index funds, right? And to a certain extent, bonds, right? How do you store your value over the long term? Well, if I take money and I buy a mixture of stocks and bonds, that will store my value, because if the economy is healthy, the stocks go up by 10% a year. The S&P does. And if the market, the economy is not healthy, the Fed will lower the interest rates by 50 basis points and the bond will trade up. And so that works for how long? It works, watch the interest rates for the last decade. It works until you crank the interest rates down to zero. It used to be overnight money was 550 basis points, Tom, before the great financial crisis. And then they cranked it down from 550 to 500 to 450 to 400 to 350 to 300 to 250 to 200 to 150 to 100 to 50 to zero. And now we have, the bankers say, I'm not even thinking about raising interest rates. So that breaks bonds as a store of value, unless you go negative interest rates. And stocks work, except for the fact that, what stocks worked in the past decade? Apple, Amazon, Facebook, Google, a big tech company that grows 20% a year top line. When Apple stopped growing 20% a year top line, they fixed it by taking on massive amounts of debt, buying their stock back, and leveraging up their EPS. So companies that grow faster than the rate of monetary inflation, faster than the 7%, they could hold value. A company growing 20% like Google, Facebook, or Amazon, they all hold value. In fact, they accrete value. Why? Because 20 is more than 7, right? So it's plus 13% a year, right? What happens to all the other companies? Which companies in the S&P 500 amounted to all the indexes, or to all the gains? It was big tech, right? Big FANG stocks were the winners. Everybody else treads water, because if you're growing at 7% and the money supply is collapsing at 7%, you're net zero. And how else do you get around it? Well, you can go borrow a lot of money, leverage up, buy back half your stock, and get your cash flow per share up. But what happens when you're fully leveraged, which is like where they are right now? You can't do it anymore. So what's the problem right now? The problem today is the currency is being devalued at 20% a year, not 7% a year, right? I turned up the heat in the frying pan. And the second problem is some stocks could hope to grow 20% a year, like the minority, 5% of them could grow 20% a year for the past decade. What percentage of stocks can grow 30% a year? Because now you got to grow 30 or 35% a year because the hurdle rate just jumped. Now you're pushed out on the risk curve here. You got to take massive risk as a company to grow that fast. You got to do acquisitions. You got to burn the candle on both ends. You got to take on massive new leverage. This is squeezing. Value stocks don't work, right? I mean, it squeezes you out of the value stock trade, because if the company is reliable and it's growing its cash flows 5% a year, and the money supply is expanding at 20% a year, cash is trash. Back to my story, right? Why is cash trash? Because I had a value stock with a lot of cash, and the money supply is expanding,